our last segment. So we spoke about opportunities. We spoke about the insurance and private credit dynamic. We're going to move into, risks and what we see in the market. We've heard a lot of rumbles out there in terms of people seeing some cracks in the private credit market. What is noise? What is signal? Tell us from your perspective.
If anything, people are somewhat concerned about an upcoming recession, and the first group to get hit would be the consumer. Looking at consumers now, if you think about who we're partnering up with, is the fintech lenders, and they're using all sorts of different AI tools to be able to monitor, analyze the underlying consumer. Now, we don't rely on their analysis. Obviously, from our perspective, we have to do it from a banking regulatory standpoint, but it is interesting to see how maybe a fintech is analyzing the credits on the underlying consumer versus we could take some of that information and then be able to take our analysis and do the comparison and see, well, are they getting it right or not? Now, as far as what's happening today with the First Brands and the Tricolors, we're not in auto. So that's one of the areas that we're not playing in. But, you just have to monitor these things. They can be very isolated. And that's how we're kind of seeing it today. We can also be proactive in the way that we bid on the loans, right? We don't have to just take the loan at the same price. We can take a haircut, buy it at 90 cents on the dollar, and actually build in a bit of a protection behind it. And that's part of the whole risk analysis, right? Or the risk management side of it. You estimate what probability losses would be on a conservative 10 to 15%. And then you could also stress test these portfolios and see, well, what does it look like in a GFC type of scenario where consumers are maybe 30% losses, right? And now you have these parameters that you can analyze on top of all the regular underwriting credit analysis that you do. So we kind of look at a bunch of different, a mosaic approach. But as far as some of the initial things that we've seen so far, it seems like it's been somewhat isolated and in a very individual area.
Yeah, and yourself, Rich, from an allocator's perspective, you're looking at things from a very macro level. Yeah, what are the things you're looking out for?
I think a statement that will prove to be true is we will see cracks in the private credit market in an area where the real economy has a bubble or a crack. So if you want to know where we're going to have a problem in private credit, we need to look at the real economy. We were supposed to have a problem this year with commercial real estate loans because of the wall of maturity. We went from something like $510 billion in loans maturing last year to $650 billion this year. We're in the 11th month of the year, and that problem hasn't come through yet in terms of a wave of defaults or forced selling or other bad things. And the next several years, maturities are actually lower than this year. So there is a sense of all tides lifting all boats in the economy, but the 10-year Treasury is down 50 basis points. Credit spreads have come in. The short-term interest rates are down 100 basis points from the peak. If we were going to see that kind of macro stress in commercial real estate or more broadly, we might have seen it so far. Neither of the two recent bankruptcies in the auto sector actually involved private credit. I think the media jumped to, oh, this is the first sign of a private credit problem. It was actually publicly issued credit and bank loans. But leaving that aside, the auto sector gets a lot of attention because that's usually where we see the first signs of weaknesses in the broad economy. But the broad economy remains pretty strong. We seem to be getting actual productivity gains from the AI investment. And I think the push of private credit into financing consumer expenditure or small and medium business activity, those are big parts of what underlies the thesis of U.S. economic exceptionalism and what's continued U.S. economic strength, despite the shocks of Liberation Day's announcements, a record government closure that continues, and so on. We continue to power through. The S&P 500 is up nearly 17% year to date, and that rising tide continues. And now we've got lower refinancing rates than we did 11 months ago.
So access to cheaper capital, allowing for American entrepreneurship to carry on flourishing. Over to you, Peter.
Yeah, I just wanted to say, I think there's an interesting virtuous feedback cycle here too. Over a career, the financial markets have become more and more important to the real economy. It's almost impossible to separate them. You could argue that private credit has in fact helped forestall that wall of defaults that we were talking about. And so private credit supports the real economy because there's a demand for it. There's only a bubble when there's not a demand for something, right? There's too much supply of something and not enough demand. And in this case, insurance companies and large asset managers have a need for private credit in their portfolios. And we have a very large real estate business at 𝐸𝐭, and we are finding opportunities in commercial real estate. It was a baby with the bathwater situation for a while, but we're deploying private credit dollars that clearly have helped to forestall some defaults in the commercial real estate market. And so we're also seeing that, frankly, because when loans reside in the private credit market, if you contrast the actual default rate to the PIK adjusted default rate, the PIK adjusted default rate's probably 5 and change. The actual default rate's something lower than that, 2.5% to 3%. Correct me if I'm wrong. But the reason for that is because the holders of private credit are, generally speaking, very strong hands that can negotiate PIK deals with their borrowers and ride it out. Whereas if they were BSLs or broadly syndicated loan owners, they might not be able to do that because BSLs sit at banks, et cetera. And that has also, I think, helped to forestall the default cycle, which can then sometimes lead to an economic downturn.
Maybe just to add, just from our perspective, I'll echo a lot of the sentiments from the panel, but there is a lot of different flavors of risk out there. And so if you look at, for example, residential real estate and the type of underwriting and the quality of underwriting there, we think it's still really, really strong. And you see that in both the loan to value ratios of the underlying loans, the loss given default being still extremely low. Whereas there are other segments of the market, especially if you think of the subprime end of the consumer, where you're starting to see some worsening of performance. So I think as long as you have the ability to not be stuck in one lane and to look across a breadth of sectors, there's always some relative value to be had there. So for example, what we like today is the prime end of the consumer. Very often they tend to be homeowners. They have a low interest mortgage rate where they have low debt service obligations, and that end of the consumer is holding up much better than the subprime. So between all of these markets, you can perform a bunch of relative value, and then maybe just adding on to issues that are more idiosyncratic around Tricolor or First Brands. I think what we've learned from that exercise is, one, it is a competitive market. There's a lot of capital out there that's chasing these deals, and therefore maybe in some of these instances the types of elements of deal structuring as well as the types of diligence maybe were overlooked. And so we're very conscious around being able to make sure that we have the right structures in place. A lot of the transactions that we look at in the middle markets tend to be directly sourced and bilaterally negotiated. We have the ability to structure our own deals. And so whether that is making sure that you have the right security on the underlying collateral, the right cash controls in place to avoid some of the issues that have come up, there is a lot of ability to enforce those protections into the structure.
I think for allocators that are concerned about maybe we're later in the cycle and maybe we should be more careful, having a multi-asset credit manager or an opportunistic manager or special situations manager puts the onus of the sub-allocations onto a professional intermediary that's in the market every day and might be able to get your committee comfortable with continuing to allocate if they're worried about spreads having come in late in the cycle and so on. I want to double down on Peter's comments on the performance of private credit as an intermediation vehicle relative to bank lending. Regulators are keeping an eagle eye on this, but the thesis is that banks weren't the best lenders. Taking depositor money, guaranteed liquid, guaranteed return, perceived as risk-free, and lending that out long, that didn't actually serve us very well through a number of economic recessions. The private credit industry is maximizing economic value of recovery, even in workout situations. The counter argument is we have seen some lender-on-lender violence recently, and that's catching the eye of regulators because that kind of contradicts the thesis that the workouts would be a bit more normal. The last comment I want to make on regulation, Sulekhan walked us through kind of the U.S. insurer environment, or how we've talked about how rated note structures work. A lot of our European insurance clients wish they had the U.S. regulation. They still can't hold commingled interests and GP intermediated funds in a capital efficient way. There's no equivalent to rated note structures, or those are still cutting edge, bleeding edge, not proven out. The UK government in particular, every time the regulators reach out to me to talk about, well, why can't we get pension funds and insurers to invest more in UK infrastructure, UK private equity? I flag, well, you don't allow rated note structures. How are they going to hold the commingled fund interest? They can't even do the private credit component efficiently. If you expect this to work, you actually have to do the regulation to accommodate the asset class.